As has become customary, these types of talks, I like to start off with a cartoon, and this one does, I think, a pretty good job of encapsulating the current state of affairs. There's certainly a big bull market going on, and with all the rhetoric in Washington about the swamp and the debate about that, it's those very same policies coming out of that swamp that have given rise to this unprecedented bull market that we'll talk a bit about. The little alligator there is a reminder that bull markets do climb walls of worry, and there are some problems lurking that we need to pay attention to, and I'll get to that in a few moments. But really starting out, this record-setting bull market that we've seen has really been driven by very strong earnings growth. The first leg up, starting in around the election time in November of last year, was in part driven by the election, but as I talked about, the last OIS, also driven by improving underlying economic trends. More recently, though, we had a very strong first quarter earnings season, and that's been followed up with a second quarter that's been just as strong. When we get to bull markets at this stage, it tends to be more about earnings growth than valuation, and with these earnings growth, things are looking pretty positive. A bit more about earnings on this page. You can see that they turned positive late in 2016. The first quarter was record-setting at almost 15%, and thus far the second quarter is clocking in at close to 10%. 70% of the companies that have reported have indicated that earnings will accelerate into the second half of this year, which is a good sign. On the chart on the right, just a quick talk on valuation. You can see that on a forward PE basis, multiples currently hovering around 18 times, which compares to the 16 historical average, really accounting for what investors expect to be accelerating earnings. This is an interesting chart that we're including for the first time. It basically tracks financial conditions and specifically how liquid or how tight or loose the market is, and it accounts for the equity markets, the money markets, debt markets, the shadow banking market. And what you can tell from this is that by historical standards, we're at a very loose monetary policy right now. The current number is right around minus 0.78, which is the lowest it's been in 3 years, and that's despite 2 interest rate increases that occurred this year. Bottom line, this does bode very well for continued equity performance, which will help and trickle down the medtech and biotech ophthalmology names. A bit on the debt side of the equation, yield curve has always been a great predictor of economic health. It continues to be steep, which is a positive indicator. I will say it flattened out a little bit in the second quarter, in large part due to moderating inflationary concerns and projections, and we could see that spelled out in a bit more detail on the right. Very much still within the comfort zone as to what the Fed wants to see, and a good supporting factor when you think about the overall health of the equity markets and keeping interest rates where they are. A quick word on China. You really can't talk about markets and the health of the global economy without a quick word on China. 15 and 16 there was contraction, but thus far since late 16 or mid 16 and into this year, it's been an expansionary stage, and that has definitely provided some wind at the sails of the overall markets. In terms of the outlook, as we close the books on the first half of this year and we look forward to the second half of this year, there's lots of ways of sort of showing this. I think the chart on the left is a bit silly, but also pretty relevant. And for those thinking this in the back of their mind, yes, us bankers and Wall Streeters have indexes for basically everything. And the one on the left is a partisan conflict indice. Basically measures gridlock in Washington. Historically, the higher it is, the less control one party has over the policy, and I would say nowadays that's probably a pretty good thing. But when you go back and actually run numbers on it, when it's been above 100, you've had very good returns, and you can see where we are historically. So this does bode well as we head into the second half of this year. So that swamp is actually helping us. In terms of another way of looking at it, typically, if you had a good first half of the year, you've balanced it out with a very strong second half of this year, And the first half equity performance came in at just over 7%. And when you look at that in terms of history, that correlates to a back half that will be roughly the same. So looking at strong equity performance through the remainder of the year. But there is some concern. We've got asset bubbles that are at all-time high right now, really a function of the loose monetary policy. You can see that we're just about where we were during the housing bubble and very close to where we were during the tech bubble. Something to be concerned about, something to watch. And likewise, from an economic news perspective, recent news has been less than what the street had been expecting, and you're seeing a fall off in that surprise index on the right. Again, something to keep an eye on. So it's not all roses. So what does this mean for healthcare? Healthcare has performed very well year to date. It underperformed in 2016, and a lot of the performance this year was really, I think, a turnaround. Investors chasing underperforming sectors last year into this year. Healthcare has also been helped by a better legislative backdrop. The Trump administration seeing as being more sort of pro-industry versus that would have been for the Clinton administration. And you've also had very good earnings in the first half of this year. For medtech and biotech specifically, I don't want to read too much into stock price charts, but in the interest of time, I'll focus on the medtech index here. You can see in April, it really, by the blue line, it really began to distinguish itself from the overall market and the biotech index. Again, driven by an improving legislative backdrop or the perception thereof, strong earnings, and good M&A trends, particularly the C.R. Bard transaction with Becton Dickinson. Specifically as it relates to the ophthalmology, medtech, and biotech subsectors, as you can see from this slide here, we've had a fair share of good news and not so good news, but for the most part, the good news has offset that of the bad news. You can see the medtech as depicted in the yellow line or the orange line there on the top continues to outperform both the biotech as well as the broader OIS Index, which I'll describe in a second. But one of the key drivers, which really hasn't changed over the last couple of years, has been this M&A backdrop. There's seems to be a consistent M&A bid to the valuations. And also, from an innovation standpoint, we're seeing a lot of new technologies get a lot of interest amongst investors and are coming of age as they go through later stage clinical development. A quick shout out for the OIS Index. It largely mirrors what we have there for biotech and medtech, but does include some microcap names, which accounts for more of its volatility. From an IPO and M&A perspective, it's a little bit of a tale of two cities here when you look at biotech versus medtech. Biotech, both products are pretty active. We've had 22 IPOs year to date. The chart on the right describes the rolling average performance of the IPO class since 2016, and it's clocking in at 50%. As long as that's above 20%, the IPO product is quite viable. From an M&A perspective, I think there's still a bit of digestion going on in the biotech sector from the activity we saw in 2015, and that's the tall blue chart on the top left. MedTech is pretty opposite. You're not really seeing any IPOs. The hurdle to go public is a lot higher. It needs to be more of a commercially oriented story versus a clinical development execution story. But from an M&A perspective, incredibly active. We're on track to outpace last year's record year, and that continues to be the key driver, I think, in MedTech broadly and also MedTech ophthalmology for the publicly traded equities. A little bit more about that on this page here. What's interesting, if you look at above the line, those are all M&A transactions since January of 2015. All of them but two were private companies being acquired. So M&A continues to be, I think, the mode or the exit of choice for venture capitalists, in large part driven by a couple of factors. One, IPO product is really not open to a lot of these companies. And secondly, we've seen more innovative deal structures between buyer and seller that allows private companies to more confidently capture their value and for the acquirer to more properly sort of manage risk. Thus far this year, we've seen two transactions of note in our sector. Novartis did acquire Encore Vision. J&J acquired Tier Sciences. Would be remiss to say Piper Jaffray was involved in both transactions. We were honored to do so. And then Cala recently went public as well. Not much to talk about here on the fact they were all sort of front of the eye indications, but I wouldn't read too much into that. And then finally, when I take a look over the next year and a half, what's to come, a lot of exciting developments and catalysts on the horizon. I always like to sort of look at it this way, and you can see that it's sort of top-heavy in terms of a lot of activity in the NDA approval bucket, and the phase 3 bucket. Those tend to have more of an impact on stocks and earlier stage type clinical development events. But a number of exciting events on the horizon that I think will continue to drive investor enthusiasm for this sector as well as potential M&A. And with that, I will, actually one final slide, I'm a little bit over. It is second quarter, so we do like to keep track of what the large consolidators are indicating about their outlook. And when you take a quick glance at it, they all seem to be very constructive on the sector, making investments in growth and expecting good trends going forward, which again is a positive indicator. So with that, thank you very much. Appreciate the time.